I'm certain that my life is a lot like every one of you in this room. So I spent the majority of my life grinding it out in public accounting. I started my career at Ernst & Young, spent a decade there. I was a tax manager when I left, essentially worked in and out of public accounting for most of my life. I formed my own CPA firm about 15 years ago to address primarily what I kind of viewed as weaknesses in terms of how clients like you got served by their accounting team. And what I had found over a career of work is that, accountants are really good historians. We're good bean counters. We're not necessarily great tax strategists. We tell you how much money you make, how much you owe, when and where to file your taxes, and oftentimes how to write large checks at the last minute when you least expect it. And maybe some of you can relate to that experience. I had found that kind of pervasive in the accounting career over a career of work. And I formed my firm because I'm a tax planner. I'm a tax strategist. And when people come to me wanting me to take care of their taxation issues, I talk about how can we recover dollars that you unnecessarily pay in the form of state and federal income taxes. And so I've had a very successful CPA firm for 15 years, but I've grinded it out. With taxation work, it's intensely time demanding during peak periods of the year. Oftentimes you work 14 to 16 hours, and I did that for a long time. And I would say about 8 years ago, after I had been working with JT for about 3 or 4 years, both of my parents passed away within 6 months of one another. They did not get to enjoy for a very long period of time the accumulated wealth that they had. And it was kind of a catalyst for me to say, I don't want to go out the same way that they did. And right now I have no balance in my life. I work an ungodly amount of hours. I tripled the income that I was earning at owning my own CPA firm, so I felt like I had made it. But I really hadn't accumulated wealth in the way that would allow me to walk away from the job anywhere before age 65, right? Or maybe even longer. 3 kids, educated them all very well, created wonderful citizens out of them, but that's expensive, right? Private schools, things like that. So I said tomorrow is the rest day of my life when it comes to health, wellness, nutrition, and having balance in my life. And I actually gave 30% of my CPA firm away to probably the best technical accountant that I've ever worked with. She's a real estate accountant. She's based in our main office in Houston. And what that did is it allowed me to do what all of the clients that I had worked with over a career of work do: accumulate wealth by getting involved in 2 asset classes: passive investment real estate and alternative investments. So I took the half a day that I freed up to create opportunities for myself and ultimately for my clients to participate in. And that created a massive multiplier in my life to where today I don't have to work near as hard as I used to. I enjoy a much better balance. And yes, I love to fly fish. 2 things that I'm passionate about are playing tennis. I still have a few years left with rickety knees, but I fly fish as often as I possibly can. And this is a massive brown trout that I caught on the White River in Arkansas. And it happens to be in a location where I bought a very large property, a 6,500 square foot house 2 years ago that I converted into a fly fishing lodge, and I get to go there and I have 4 world-class guides that I get to make use of. But had I been sitting behind the desk as a CPA cranking out tax returns and doing tax planning, I never would have had those opportunities. I try to go once a quarter. After I stopped practicing day-to-day as a CPA, I started an asset-backed lending business. And I started a lending business that caters to a couple very narrow niches. I'll tell you a little bit more about them. But one of those is the entertainment industry. I'm a bridge loan lender, a collateralized lender in the entertainment space to independently produce major motion pictures. I started this with a London film financer and a Los Angeles-based film finance attorney. Started it with my own money. A couple $100,000 turned into a $75 million business. But I went from sitting at a desk in Virginia, where I'm originally from, cranking out tax returns, to 18 months later, after I gave away 30% of my firm, to being at the Cannes Film Festival in France. And I'm at the Prince of Monaco's palace because we financed a movie that he sponsored called Royal Ice, which was about the Prince of Monaco's bobsledding team. So you ever think about the Prince of Monaco having a bobsled team? Well, he did it. And we created a movie and helped finance it, and I got invited to a party that celebrated that activity. So literally, my life changed in a matter of 12 to 18 months. So although I am a wonderful tax planner, I call myself a wealth accelerator. I help people grow their wealth in unique ways by focusing on a couple of critical areas that make a massive difference in your financial life. And that's the roadmap that I have followed personally. It's the roadmap that my clients follow. And I'm here to kind of share that story with you. The one thing that have been observing, and many of you share these concerns, is kind of what is happening structurally right now in our economy, what is happening structurally in our tax system, what is happening structurally from a political perspective. I mean, what are your biggest concerns that you sit here and think about day to day relative to your financial life? What are the major risks? Well, our Treasury Department has said that we are going to decouple interest rate policy with inflation policy. So we're going to let inflation maybe tick up to 2%, and as long as we're below 2%, we're not going to raise interest rates. Interest rates have been great for us as investors, right? It has created immense demand for real estate. There's been immense appreciation, which is a bonus for most of us, but I am concerned about what is going to happen financially in the future because of all of the borrowing, 2 rounds of stimulus, and maybe a massive infrastructure spending bill that's going to put pressure on the Treasury to raise interest rates. And if you just look at, this is a few snippets of what's happening to the financial markets. We've seen a lot of volatility. We've seen the Biden administration come out with some very aggressive tax proposals, wanting to close real estate tax loopholes, and potentially a very different economy in the future. So I think now is no better time to have a financial plan that addresses potentially some of the structural issues that are going to happen, potentially addressing what's going to happen from an enforcement and a tax rate perspective. Those are all things that I think people should address today. We've got, for many people, a lot of built-in gains in our portfolios, both in the financial markets, both in alternatives and real estate. What do we do with those gains today? How are we going to be taxed in the future? So I'm spending all of my day right now helping people make those decisions. I spend most of my time right now either raising or deploying capital or having valuable conversations about tax strategy, entity structures, and what we should do in today's economy. I have found over a career of work, there are about 4 things that make a big difference in terms of how much and how fast you accumulate wealth. The first 2 are income and savings. Pretty rudimentary. The more income I earn, the more ability I have to save, the more ability that I have to grow wealth. The biggest problem I have found over career work with respect to income is most of us in this room have had probably a job or may still have a job where you have high active income. Get paid very well for the work that you do. I did for 20 years. I performed at the peak of my accounting profession, made more money as an accountant than most do, and felt like I was on the right track. The problem is most of us never develop alternative sources of passive income that ultimately complement the work that we do and ultimately give us the ability to have a source of income that outpaces the active income that we have today. From a savings perspective, probably most of us are pretty good at savings. If you're a high active earner, you save money, but it's purposeful savings. Most people are taught, especially in my generation, stick your money in the financial markets, let it grow. One day there'll be enough for you to ultimately retire and sustain you for the rest of your life. That doesn't happen anymore. Problem is, most people put a lot of money in the financial markets. I know this group's a little bit different. You're active real estate investors. You made some good decisions there, but you're not going to grow your wealth by simply having active income and savings. 80% of your ability to grow your wealth and rapidly grow your wealth, to create a financial multiplier in your life, is dependent upon 2 factors. taxation, and investment performance. Taxes take an enormous amount of wealth out of your life. As high active earners right now, if you're in the upper marginal brackets, you're paying 37%. Potentially that's north of 40% in the future. The last thing that we want to do as high active earners is have investment income during those years that gets taxed currently. That cuts down your compounding power and ultimately reduces the amount of invested capital you have later on in life. What I have found over a career of work from a taxation perspective, as you get older and as you walk away from your job, your marginal rate of taxation drops. And actually, typically, your spending need decreases. So you need less cash flow as you get older, and we can take out income and gains much more tax efficiently as you get later on in life and have less active income. Investment performance. You're not going to make it by investing in stocks, bonds, and mutual funds. So from a taxation perspective, which is what I'm going to start with, it all revolves around the accounting relationship. How many of you in this room have been frustrated over time with the advice and guidance you've gotten from your CPA? I've heard that forever, because most CPAs do simply what is minimally required, which is prepare your returns. Get your information after the close of the year and kind of give you the facts, numbers, and statistics and leave you to pay your bills. And this is representative of a client back in 2019 that came from me that had a very successful company with his brother. And here is a email from his accountant. And look at it, it's December 8th. So what do you have, a couple of weeks to plan for the end of the year? It says, attached is a spreadsheet with calculations of how much you and your brother Justin should pay in taxes before the end of the year so you have sufficient withholding to protect you from penalties. The important amounts are the state and federal withholding. I have also attached projected tax returns for you, estimating the company will pass to both of you $350,000 in taxable income. You will each owe around $120,000. That will be due on April 20th. Any questions, please call me. That's what most CPAs call as tax planning. I call that tax suicide. He came to me, both of them did, needing a strategy before the end of the year. And what I will tell you, we got that liability cut by 30% between December 8th and December 31st. We cut it in half in the following year by just simply having a strategy. One of the things that I find very powerful is how much of a difference does tax planning make economically to you in terms of accumulated wealth. And this is an illustration of the value of tax planning. And this is assuming that you have $500,000 and you can earn 18% per annum on your investment. If I'm able to engineer a tax strategy that keeps that income off your 1040 today at a 35% rate, after year one, you're going to have an additional $31,500. By year 5, that grows to nearly $275,000. By 10 years, you've doubled the size of your investment just by having a tax strategy. You have $1.1 million of additional accumulated wealth, and by 15 years, it's 3.3. Taxation is the most important decision that you need to make before you get involved in an investment, before you engineer your exit strategy, because the reality is this is what you're giving up. You can't have tax strategies typically in stocks, bonds, and mutual funds, but you can have it in real estate, you can have it as an active business owner, you can have it with alternative investments. That is the playing field where we play what I call tax chess, moving the pieces on the board in the favor of you as individuals rather than in the favor of the IRS. And what happens is you create massive savings. So what's coming? I mean, I call it the Biden 911 tax attack. And it's interesting. So initially, the Biden administration came out with what they call the wealth tax, right? A broad-based approach to increasing both corporate and individual rates of taxation, eliminating deductions and phase-outs, and changing a lot of things that made a big difference to people who own businesses and who are successful investors. Then they backed off, and they said the only thing that we're going to do is increase corporate taxes. Well, what they've soon realized is those limited changes, just segregated to corporations, was not going to generate enough revenue to cover the spending that's occurred during the pandemic and to cover essentially the massive stimulus bill they would want to implement for all of the infrastructure improvements and what looks like a very socialist type means of reallocating capital to the middle and lower income categories. And so these are some of the things that we're looking at. There's been discussion of increasing the margin rate of corporate taxation from 21 to 28%. Probably doesn't affect a lot of you here. That means a regular C corporation that files and pays its own income tax. But the C corporation is probably, unknown to many of you, a very powerful entity from a mitigation perspective for investors. Trump did us a big favor by dropping the marginal rate of tax on corporations from 43 down to 21%. Why did he do that? To be able to repatriate profits where companies have moved offshore, because our marginal rate of taxation on corporations is very high compared to the rest of the world. The Biden administration wants to change that. They want to increase corporate taxes. I completely disagree with that policy. There's been a significant growth in overall tax revenues from corporations when Trump cut the rate to 21% because more people came back to do business. We stopped all of this funny foreign offshore planning because we didn't need to anymore, because actually we had a rate advantage now compared to many jurisdictions, so we're happy to do business in the country. I have a lot of investors that generate foreign sourced income, JT being one of them. So what do? If you have foreign sourced income, you could, under previous administrations, form an entity for that type of income that's generated offshore in a more favorable jurisdiction and enjoy the benefits of a much lower rate structure. We did that. JT traveled around the world in 37 different countries, did business there. We had all of that income going somewhere else besides the United States, simply because if he ran it through a company here, he's either paying 40% individually or 43%. I'm not going to have a client give away 43% of their income every year. You'll never get out of the rat race. So people brought their companies back to the United States, and the actual total collected revenue from corporations increased under the Trump administration. Of course, the Biden administration wants to raise the top marginal rate back to what it was in the Obama years, 39.6. And here's a big one, and this probably affects every one of you in this room, is a potential increase in the capital gain rates from a high of 20% to up to 43.4 if you have income above certain thresholds. The threshold that's been discussed, which ultimately will not be where it lands, is $400,000 for a married filing joint. And how do they get to 43? It's actually 43.4. They take the 20% rate, double it, and then add a Medicare surcharge on top of it. And that's how they get to 43.4. So most of my conversations today revolve around item number 3. What do I need to do today to take advantage of a 20% marginal rate? What can I do potentially to bring capital gains out in a lower rate category where if my income is below certain thresholds, I don't pay capital gains if I'm married and my adjusted gross income is below about $70,000. For some people, I can take capital gains out tax-free. For some people, it's 5 or 10 or 15%. At the top end, it's 20. Those are the things that you need to be thinking about today. What happens if we miss the window and we sell something later on? If you sell something later on and by accident you're above the $400,000 threshold, all these things potentially kick in. We want to avoid that eventual outcome. Payroll tax on earned income above $400,000. So if you think about it, as an active wage earner or an active business owner with a salary, you pay Social Security and Medicare tax. Social Security phases out at about $150,000. Well, the Biden administration wants to say, okay, well, if you make more than $400,000, we're going to add it back and add that surcharge both to you as an employer and as an employee. A further phase out and limitation on itemized deductions. Even real estate investors under the Trump administration got this 20% business deduction. That goes away if you make more than $400,000. A potential elimination of the step-up in basis for inherited property. So you're the beneficiary of your parents' estate. They pass away. You have a property that they've had for 20 years. Let's say they bought it for $100,000. It's worth $500,000 today. When they die, your basis in that property today becomes $500,000. Potentially in the future, you have a carryover basis. And now a capital gains rate up to 43.4%. What should I do today maybe to take that risk off the table? And here's another one. The elimination of the like-kind exchange, the 1031 exchange. How many of you have used a 1031 exchange in your life? A lot. It's a very powerful wealth accumulation tool. The strategy all along has been we take our deferred gains, put it into the next property, and then we refinance our cash out and do it again. The IRS has attacked that strategy in the tax courts for decades, and they've lost every time. The whole process of doing a 1031 and then cashing out through a refinance, that ability to enact that strategy exists today, and it's been a great wealth accumulation tool for many of you in here. But what happens if we lose the ability to do a 1031? What should we do today? Should we execute our last 1031 maybe? Should we potentially sell and recognize gains at a 20%? Those are all individual conversations, and those are the things that we're talking about day in and day out now, because this kind of stuff is coming. The IRS was successful 2 years ago in eliminating the 1031 exchange on personal property. So if you had an automobile in your business and you wanted to buy or sell that automobile, you could defer the gain on an automobile into another business auto. Can't do that anymore. So the IRS was successful 2 years ago in getting rid of a component. The 1031 for real estate investors is on the blocks, and it has probably a pretty good chance under this administration of getting eliminated. And then we've all benefited from potentially a significant increase in the estate tax exemption. Right now it's $11.5 million. It's twice that if you're married. Maybe it goes down to $3.5 million again, $7 million if you're married. So a lot of changes, a lot of uncertainty, but things that you can do today immediately to potentially address some of these things that are coming. So how do you go about tax planning? What is it that I do that other CPAs do? And what I tell people, it's not rocket science, and most CPAs could do this work if they simply took the time. So many CPAs are so risk averse, get paid so well from a margin perspective for doing the compliance work, and frankly, just get so busy and so overwhelmed with the paperwork, they never have the time to do the planning. But what we do is go through a systematic process in terms of helping you control the cost of taxation, and it really revolves around 3 critical areas. Business structures. The use of entity structures ultimately allows you to drive down the cost of taxation. Each entity type, whether you're using a corporation, an S corporation, a limited partnership, or an LLC, each of those entity types have different legal and tax attributes. What we simply do as planners is go through and look at what's happening in your life from a financial perspective in terms of how am I generating my investment income, what alternative investments am I invested in, what types of business interests do I have, and simply fit the most favorable legal and tax attributes to your unique financial lives. And that process drives down the cost of taxation. Then we tell you we're going to volunteer to pay tax on the income that we need to live off of, the income or cash flow that we need to support our lifestyle. But it's going to stop there. Once we've satisfied our lifestyle needs from a cash flow perspective, and we engineer strategies that ultimately keep that component of your cash flow low from a taxation perspective, we say then I'm going to train the rest of the income that I generate, either from my job, my business, or from investments, to flow into an environment where I have much more control. The last thing I want to do is pay tax on income I don't need today. And in the tax toolbox, there's a number of strategies that allow us to keep that income off your 1040 today. And then the last thing I look at is, what about fringe benefits? What types of things are you paying uniquely in your financial life today with after-tax money? What can I do from a legality perspective to engineer a strategy, maybe by using the right entity type, to reroute those types of things into structures where we're legitimately allowed to take a tax deduction? It's called benefit planning, executive level fringe benefit planning. As real estate investors, you have the unique ability to take advantage of all three of those planning categories. What happens when you go through this process, you do drive down the cost of taxation. In every instance, with every client that's gone through this process, we've saved money. And if you're not having conversations on a regular basis with your CPA about these three items, as things change in your financial life, as new opportunities arise, you're paying more than you necessarily need to. You also, oddly enough, allow yourself to fly under the radar of the IRS. It's interesting. I have about 3,500 clients, much like you, that I serve through our CPA firm. Last 2 years, 0 audits. Right now, the IRS has been decimated over the last decade in terms of funding and the size of its workforce. The size of the IRS today is about the size of what it was in 1957, when the economy was a seventh of the size it is today. So we do not face significant audit exposure today, but that is about to change. The biggest change you are going to see on the landscape from a taxation perspective is enforcement. And I'm going to kind of walk you through what I see happening, because I've been on the forefront of what it's like when people get audited heavily back in the mid-'80s. And it's no fun. I've helped clients, like I said, through criminal audit procedures. No fun. A brief primer on entities. And I could spend 3 days educating you on the unique tax and legal attributes of each entity type. But here's the kind of rules of thumb. Flow-through structures are generally ideal for business owners with active income, typically S corporations. So if you're a business owner, whether you're an active real estate investor buying and selling properties, a real estate agent, a professional, a lawyer, a CPA, a physician, you're going to want an S corporation as the primary entity for that business activity. The benefit of the S corporation for an active business owner or an active investor is it allows us to split income. And this is, do you remember John Edwards, the senator from the Carolinas? So he used this technique to shelter millions of dollars of personal injury settlement from Social Security and Medicare taxation. And the IRS has attacked this strategy for years, but unsuccessfully. But if you have income from your profession, you can avoid exposure to what I call garbage tax, which is Social Security and Medicare tax. I can split my income between a wage, the W-2 component like an employee gets, and a dividend. The dividend piece of the income that you get is not subject to any level of payroll taxation. So the flow-through structure for an active business as an S corporation is the first entity type that I use. Not in all instances, there's other issues that may change that decision, but in general, that's the recommended structure. Partnership limited liability companies work very well for passive activities and investments, like the things that you do with Darwin, like the fund structures that you invest in, like the syndications that you invest in. Partnerships offer unique tax and legal attributes that give you a high level of legal protection as well as some very high level tax planning opportunities. From a legal perspective, a partnership limited liability company and a husband and wife owning shares in a limited liability can qualify as a partnership, gives you the ability to insulate the assets in the partnership from any risk of loss. I have seen a few cases in my life where there's been catastrophic financial events where a partnership limited liability company has allowed clients to save millions of dollars from judgment lien creditors. The most catastrophic events that I have seen in my life don't revolve around, say, a doctor having a malpractice issue or a professional liability issue. It revolves around the use of an automobile and having one piece of insurance missing in their financial life. So I had a pharmacist in Wisconsin about 8 years ago drive home from his business, and he owned a pharmacy practice and he owned the commercial real estate in which the pharmacy was located and had a significant multifamily portfolio. He was driving home, stopped at an intersection, looked both ways, did not see the guy in the motorcycle, proceeded into the intersection, and the guy in the motorcycle T-boned his car and died on the spot. And that's a policy limits case. And he had the highest policy limits on his automobile insurance, but it was insufficient coverage to deal with a death that came from the use of his automobile. He had a lot of money in an IRA. He had his buildings, his real estate, he had his practice, and he had about $350,000 in savings. And so the insurance that he had was over $1 million in coverage, but still insufficient to cover that issue. So the good news is he had a partnership limited liability company for the real estate. And so something happens catastrophic against you and you're sued, and as landlords, not everything is covered by an insurance policy. Partnerships benefit from a legal theory called a charging order. What that means is in the event that I as a partner am sued, none of my partnership assets can be used to satisfy claims. The most that a judgment lien creditor gets against a partnership is what's called a charging order. That's a very limited remedy to a judgment lien creditor. It simply means that you have the economic rights to the distributions that I make, but the underlying equity in that entity cannot be used to satisfy that claim. That body of law dates back to Old English partnership law. It's embodied in every state uniform limited partnership code. And so he didn't lose the equity in his building. In fact, if you have a judgment lien or charging order against a partnership, you get the K1. And if there's a lot of income, you got to pay the taxes. So it's a poison pill. For the guy that was driving home that owned the pharmacy, we did a couple of things to help him. We moved his IRAs to 401ks. 401ks are protected by ERISA, the Employee Retirement and Income Security Act. They are judgment lien and bankruptcy proof. IRAs are not. And then we took the $350,000 and bought prepaid tuition agreements for his 4 kids. Still lost his business. That's what could happen. And had he had umbrella insurance, cheapest form of asset protection you can have, he never would have had that liability. I had an event very similar to this in my life. If you saw the first picture that I showed those 2 pretty girls. Well, guess who they are? They're my daughters. I promise you, they are the reason why at 25 years old, I had no hair left on my head. And I have 3 kids, 2 girls and a boy. The son is the youngest, and I learned a lot from the 2 girls, so he turned out the best. But anyways, I'll tell you a story. So it was actually when Taylor, the youngest, was 14 and the oldest, Kendall, was 17, they both worked at a company called the Whaling Company, which is a restaurant. It's about a minute drive outside of our neighborhood community. Happened to be a Friday afternoon, and Kendall was scheduled to work. She was a hostess. And Taylor wanted to go to the restaurant to pick up her paycheck. She wasn't scheduled to work. And I had bought the oldest a Toyota Celica to drive to and from work and to school. And so they both go to the restaurant on Friday afternoon, Kendall to go to work and Taylor to pick up her paycheck. And my daughters are chronically late to everything, including my oldest daughter's wedding. But at any rate, they get there successfully to the restaurant, but they're late. And in my oldest daughter's infinite wisdom, she determined it was okay for the 14-year-old who had never driven before, had no driver's license, to drive back home to my house. And they get home, she gets home successfully, but does not turn right into the driveway in which we lived in, and drives next door and picks up the cute 14-year-old boy. And what's the first thing that a kid does when they're driving in a car? They start playing with the radio, right? And we lived on a whole horseshoe-shaped cul-de-sac, and there's a guardrail. It's wooden. It's like an 8x8 post, and it slopes right down to the ground. And of course, she's looking at the radio, driving for the first time, and goes right up this guardrail, and she flips the car on its side. And I get a call from the neighborhood security. Oh, by the way, Mr. Dombeck, your daughters have flipped your car, and it's in the neighbor's front yard. Now, fortunately, no one was hurt, but when we think about risk in our financial life, it's not the pandemic, it's not the subprime crisis, oftentimes it's kids and grandkids, because if you don't have the right protection, and oftentimes kids, even the millennials today, and my kids are millennials, it wasn't like when we were kids, when I left the household after graduating from college and had to get a loan to go to Pensacola, Florida to start my first job. I didn't ask my dad for money. My kids still ask me for help from time to time. It's different. Kids actually are if you read about it, are some of the biggest risks to our accumulated wealth. Kind of got off tangentially there. But anyways, partnerships offer immense levels of legal protection in the event that something happens unfortunate in your financial life. Partnerships from a taxation perspective allow you to do what we call special allocations. So let's say, for example, you're in an investment partnership and you've got one individual that puts up all the capital, has high income, another individual is doing all the work, doesn't have high income. I can allocate all of the depreciation deductions to the guy that has the most income that can actually use those things. So partnerships give you a lot of flexibility in terms of allocating tax attributes to the partners who need to use those the most. And then C corporations, those are the entities that Trump cut the rate down to 21%, are companies that file and pay taxes at their own rate. But everyone says, oh, they're subject to double taxation, you don't want to use them. Well, what if I could put just enough money into a C corporation to take advantage of all the unique properties that it has? And that's something that we can talk about and has a lot of power because it's the only entity that I can pay for a lot of fringe benefit expenses for an executive owner, for example, run my cars, my health insurance, my out-of-pocket medicals, dependent care reimbursement, tuition reimbursement. There's a whole plethora of things that I can pay for through there. If I'm an active real estate investor and I'm not contributing to a retirement plan, potentially this entity can do that. So what do C corporations do on the tax chessboard? One is they allow me, for high income earners, to take income out that would be taxed individually at 37% today and drop it down to a 21% rate. And I can let that money stay in there and get invested. If I can invest in dividend producing investments, I get a dividends received deduction, 75%. I can pay for all of these things with a pre rather than post-tax dollar. I can reimburse myself for use of the home for a once-a-month board meeting and a semi-annual shareholder meeting. 14 days a year of income for the use of my home, that's rental income, is tax-free. I can have a fiscal year end, say September 30th or October 30th. That means I can defer recognition income for a full 10-month period. What happens if I have a financial event in 1 year that bunches up a bunch of income and I want to level that out? I can't do income averaging anymore individually, but I can upstream some income here and potentially get myself out of adverse tax rate categories individually. So the C corporation can be used quite creatively and quite helpfully from a tax planning perspective. When it comes to tax planning, I like to have three pools of wealth: an after-tax bucket, a tax-deferred bucket, tax-deferred being IRAs, old 401ks, where the income and the investments that you generate in a tax-deferred bucket accumulate till later on in life when you start to take them out after age 59 and a half. And then I like to have a tax-free bucket. Most of the clients that come to me have buckets number 1 and 2. Most people don't have bucket number 3. So one of the things that we try and do is help you get bucket number 3. The benefit of bucket number 3 is later on in life, I can draw income out of all 3 buckets that allows me to, number 1, fill up the low rate categories to satisfy most of my income needs. And then when I start getting into high marginal rate categories, I start drawing wealth out of bucket number 3. That allows me to keep the marginal rate of taxation down to about 20% for most of my clients. This is an entity called I call it a preferred limited liability company, and this is how you create tax-free wealth. You have to have, as a component to this, a Roth IRA. How many have told you that I make too much money to fund a Roth IRA? Right, most of you probably do. You can create a backdoor Roth IRA, which allows you to get about $6,000 a year, but it's not enough. A preferred LLC is simply a limited liability company taxed as a partnership with 2 classes of members. So how many of you have invested with Darwin in a syndication? So typically in a syndication, you own 1 class of membership interest, right? You're a Class A member. Darwin, as the sponsor, owns Class B. As a Class A membership owner, you typically get a rate of return from a couple of sources. You get a preferred rate, right? Maybe 6, 8, or 10%. That's a fixed guaranteed rate. Plus you get a share. In this entity, it's no different. You have 2 classes of membership. Your traditional IRA and your Roth IRA come together, they're self-directed accounts, and they buy shares together in a multi-member, multi-class entity, where the traditional IRA owns Class A, the Roth IRA owns Class B. In the ideal instance, the traditional IRA comes in with 90% of the capital, the Roth IRA comes in with 10% of the capital. And this is probably one of the most important strategies I'm going to share with you today. I am able to limit the growth in the traditional IRA by giving the traditional IRA a risk-free, guaranteed, cumulative rate of return. That rate of return is tied to the IRS midterm AFR rate. Right now it's 4%. The traditional IRA comes in with $900,000. The Roth IRA comes in with $100,000. In this instance, the way I got $100,000 into my Roth is I took the $1 million that was in my traditional and converted 10% in a Roth. I paid a little bit of tax to do that. But now I've got an investment that generates 18% per year. On the $1 million of capital, what does the traditional IRA get? 4% a year. $40,000 in the first year. The excess rate of return goes to the Class B member, which is my Roth. This is a strategy that supercharges your Roth, and it only works when you have high-performing investments. It won't work in the financial markets, but it'll work here with Darwin. It'll work in all the alternative investments that I'm involved with, because I can route the excess earnings into a tax-free environment. After year 1, I've got 240 in my Roth. After year 5, I've got 1.1. After year 10, I've got 3.4 on an 18% performing investment with $1 million of capital. Is that a powerful wealth accumulation strategy? You'll never hear about this kind of stuff talking to your financial advisor or to another attorney and to most accountants. This works for individuals like yourself that have an appetite for real estate and an appetite for alternatives and that have high-performing investments. I've had one of these in my life. A husband and wife can have this together. And it becomes about later on in life, in year 10, potentially most of my cash flow in my financial life can be funded from my Roth IRA. I can use my traditional IRA and maybe my after-tax assets to fund my basic cash flow needs, whatever that may be, $150,000 to $200,000 a year. Pretty much keep your income in today's environment taxed at no more than 24%. And then anything else that I want from a cash flow perspective, I fund from earnings. I mean, 10% on $3.3 million is a $300,000 a year tax-free income. That's how you play the game. Here's the other most disappointing news of the day, which concerns me more than tax increases, is the IRS is the key to Biden's agenda. So, and I've said this for years, if we want to increase the amount of total collected tax revenues, forget screwing around with the tax rates and deductions and exemptions. Don't change the code and piss everybody off. Just go out and hire a bunch of IRS enforcement agents. For every dollar you invest in enforcement, you get $5 back. We're going to take that deal, right? We're investors. We're going to invest in that infrastructure. And the original proposal was to grow the IRS budget from 12 to 15 million. Then Biden comes out and says, no, I'm going to put $80 billion into the IRS. How many heard that? $80 billion investment in technology and enforcement. Guys, I don't know what level it's coming, but it's coming. The IRS simply cannot sustain itself at the level that it's been cut to over the last decade. We are going to see more enforcement. And audits they suck. I hate doing them because they take so much time and you're not creating value for someone. And yeah, you can get paid well for it, but it's just, in my mind, a waste of my time. Why do that when I can save so many people so much more money and help them grow their wealth rather than do audits? But we have to prepare ourselves today. And the IRS publishes, it's called the Irs Data Book. It gets published every year. And I'm probably one of the only bald accountants that read this stupid book, and it's about that thick. It's an encyclopedia. And what it does, it publishes for every type of entity and every type of form, what are the audit incidences for each line item, each form, and each entity type. So then you find out what things on your tax return are audit magnets. And then it allows you to plan around those things. And there are a number of strategies that allow you to audit-proof your tax return. And that's one of the reasons why I don't have any audits over the last 2 years, besides the fact that the IRS is limited in terms of funding and workforce, is I've done a good job of cleansing my clients' 1040. And what you find is that entity structures actually reduce your chances of being selected for audit significantly. So this is an excerpt from the Irs Data Book. So how many of you have ever had a sole proprietorship or a business that you operated individually? If you reported that activity on Schedule C of your 1040, you have a 4% chance of being selected for audit, even in today's environment. That's high audit risk. If I move that activity to an S corporation, it drops down to less than 0.5%. If I move it to a C corporation, it's a 0.75% chance of being selected. If I have rental property on Schedule E, you can schedule all your rentals on multiple forms on Schedule E, then that's a high-risk form, 1% chance of being audited. If I put it on a partnership, 0.42%. The more activity you have on your 1040, the more likely it's going to be selected for audit. So I can move most of your business and investment activities to business structures where just one line item flows onto your 1040. Even with stocks, bonds, and mutual funds, I'll create a passive investment holding company where all my brokerage transactions are on a partnership tax return, not listed individually on my personal tax return. So most of my clients, they don't have 70-page tax returns, and probably a lot of you do. They have tax returns that are maybe 5 or 10 pages. They have entity returns that are thick, But again, those entity returns are not selected for audit very frequently. So as part of the planning effort today, we're saying IRS has got 3 years to come back. What happens if we get significant increases in the workforce and the budget? It's going to take them a while to get everyone trained and caught up, but people can come back 3 years later and look at things. So one of the things is audit proofing. We got to look at that. The other thing is, when do we file our tax returns? I'm filing my tax returns at the early part of the season now to get the clock started so that they have 3 years from March 31st, not 3 years from, say, some date 6 months later. So that's an overview of tax planning. I hope you found that valuable and useful. I do a lot of work in the dental field. I have a lot of dental clients. One of my best friends had a marketing company that helped dentists get more patients, kind of when the internet came out, and I ended up speaking at an event. So I've got a couple thousand dental clients, but the problem with my dental clients is their financial guys put them all here in one asset class. Problem with one asset class is every dollar you generate there from a gain or from a dividend or an earnings perspective drops onto the 1040, and at best you grow your wealth slowly. You guys realize that, right? You've changed the way you invest. Most of my clients, and I spend the majority of my day doing two things: tax planning and helping clients reallocate capital responsibly from here to here and here. Real estate and alternatives. And you probably got a lot of exposure to the real estate stuff, but the biggest message is there are two other asset classes. I am a big fan of passive real estate investment. The problem with active real estate ownership is it can become very quickly a job. The full-time operator, like Darwin, they're going to outperform the single asset investor time and time and time again. You'll get your best returns and best results by partnering either in a syndication, through a fund structure, or just a regular real estate fund, not a REIT, but a private offering. You guys know that. You've been part of this type of experience before. You get couple things. You eliminate single asset risk. If you're in a pool of assets or in a pool of rental properties where you've got 1,200 tenants, what happens if one tenant leaves? No problem. What happens if you have one asset and a tenant leaves? Big problem. So you diversify risk. You get low access to low fees. Your real estate sponsors charge much lower fees than your financial advisors do. And typically they are in the game with you. They've got skin in the game, and they win when you win. So most real estate sponsors get a share of operating profits and gains. So they have to perform to earn a fee. And then lastly, you can invest passively. You can still continue to do the work that you do that's valuable in your financial life, that creates the greatest return, but the fund structure for me and for my clients is the absolute best way to go. And I always search out for my clients the best syndications and fund structures. And one of the reasons why I'm in Dallas is because it is the private equity capital of the world. We can find these opportunities here. We can find them here in this room. I've done it myself. I have sponsored investments predominantly in alternatives, but my clients need this asset class too, and this is the kind of place that I come for these opportunities. I look for a couple of criteria when I look for operators and real estate opportunities. I look for what are the unique competitive advantages that an operator can provide. I like targeted investment strategies. So where there's a specific focus and a specific niche. For example, I love workforce housing. C+ properties, B- properties that you can do a value add that cater to 70% of the median income in any demographic environment. The reason why is those asset classes, they don't typically suffer a decline in value or an interruption in cash flow during adverse economic cycles. So what types of occupancy rates from an economic and cash flow perspective are we seeing in this asset category during the pandemic? Typically in this pandemic environment, we're north of 95% in collections and workforce housing. Why? Our tradesmen, plumbers, electricians, carpenters, they've got jobs. They've been busier now than they've ever been. Low-level white-collar workers, nurses, physicians' assistants, they've got jobs. I look for what sort of preferred return am I going to get, and what is my split? What is it, the preferred return? It's either a 6, 8, or a 10%. Am I getting 30, 40, 50%, or 80% of the share? So I look for higher preferred returns and better splits. I like companies that are operators, that do their own property management, that have their own construction teams to do the value add, that have control of the entire life cycle profit. What you find from an investment perspective is you typically triple the rate of return you're going to earn in the financial markets, right? So now for my clients, I've gone from 6 to 8% to high teen, and in this environment from a real estate perspective, north of 20%. It's very tax efficient, low fees, and I look for operators that have the ability to scale. Scaling means when I put together a syndication, I only need 20% of your capital to close a deal. The other 80% is going to come from an institutional financer. So I'm sure Darwin, when he puts his deals together, he's relying upon his syndication to provide a limited amount of capital and is getting institutional financing from the rest, which means now if I'm putting together a $10 million fund, typically I'm going to have north of $60 million in assets in that fund because I've got leverage. And you as individuals don't have to sign on the line for that. There's no recourse, but you get the benefit of the leverage. I am an alternative investments proponent. When I left my CPA firm, I kind of took a summer off, and I happened to be in Los Angeles helping a friend have opportunities as an actress to work in the industry. I had no previous experience in this industry, not really any exposure, but was just kind of taking a summer off and touring after my parents passed away. I kind of needed to reset my life and got shared a model for doing bridge lending in the independent film finance space and put a couple $100,000 of my own money into that, was quite successful, grew my individual investment in this asset category to north of $1 million, and then ultimately created a business with a second generation film financer from London and a film finance attorney who'd been closing these types of loans for 20 years, and grew that business to essentially, today we have 95% of the market share in the space, have deployed over $350 million of capital, do about $75 million of loan origination a year, and have never lost a dollar. If you think about liquidity points in your life, you're in real estate that typically has a 3 to 5 year capital lockup, where some of the alternative investments can complement the real estate by giving you a shorter liquidity point, a cash management tool where you can get in and out, have assets in at a high rate of return that would normally be in fixed income instruments like bonds and annuities if you're with a financial advisor. So for my clients, I've been able to reposition money that was kind of held in a savings account, that was held in annuities, that was held in fixed income instruments, and significantly boost their rates of return and give them the ability, when say Darwin has a great real estate investment, to redeploy their capital into this asset class. So what I have found over a career of work is this level of planning that focuses on the 80%, focusing on the tax planning, focusing on improving investment performance, and improving investment performance by not just investing in two asset classes, real estate, financials, but also investing in alternatives, creates the multiplier in your financial life. And what it does, it's done for me, for my clients, and is doing for you in the asset classes you're involved, is it pushes back the clock in terms of ultimately reaching what I call your financial freedom point. What is the point in time that I have enough passive income that either outpaces my active income or complements the income that I'm earning from my job or my profession that gives me more freedom of choice? So that is the roadmap that I believe works for people like yourself. You already have appetite for it. I think it's the way that people should invest and manage their finances. Unfortunately, our financial industry is not wired this way. The things that maybe I'm teaching here and sharing with you, you've been exposed to, but you typically won't find this kind of advice and guidance at large. You typically have to go to 3 separate or 4 separate providers, an attorney, a CPA, a lawyer, a financial advisor, and you don't get world-class advice. And this is how the family offices and the ultra-wealthy grow their wealth. They deploy capital like this, and they have their safe money very limited in the financial markets. So most of my clients have maybe less than 5 to 10% of their capital in financial markets, with the rest of it broadly invested in these other 2 asset classes. So that's my message. That's kind of the roadmap that I think people should follow. In terms of how do you get help and advice, I believe it's really about planning. Certainly, you can always find great investment opportunities, but what would it mean to you to be able to have the tax strategy married up with the investment strategy? What would it mean to have kind of a capital allocation formula where I'm deploying capital in these great real estate investment opportunities, these alternatives, and what would it mean to you to have kind of knowledge about what is the year and quarter in which I have enough accumulated capital to walk away and step out of maybe the rat race that consumes most of our time. And for me, the thing that created the biggest lever in my life was unlocking time. Time was the number one constraint. It took me, unfortunately, 20 years to figure that out. I am a relatively new DFW resident. For the last 5 or 6 years, I've actually been in California. I'm originally from Virginia, okay? So I promise you, I did not bring California liberal politics and California taxation to California with me. I came here. I was in Los Angeles because of the asset-backed lending. I mean, I literally uprooted myself from the East Coast, sold everything I had there, moved to the West Coast because of that opportunity. It's like one of those game changers you find when, preparation in your career meets opportunity, you gotta kind of go. And that was kind of what got me out there. But thank you for the time. I hope you found this valuable and useful, and I wish you all the best in your investing and tax planning endeavors.